Good evening to everyone. We are discuss about very clearly different types of expenses, including so many variety of expenses of mutual fund and different classification based on what. And we need to know about how this fees structure is classified based on systematic investment plan or based on different category, and we'll see how it is for the classified. We have explained different expenses ratio, different management fees, different delivery fees. Now the fifth one, we are talking about the fees transparency. When it's come for fee transparency, we should know that what type of fees transparency, what type of fee transparency in case of what classification. So coming to the fees transparency in mutual fund. So how this fees transparency will evaluated in form of what? So fees transparency is essential in mutual fund to ensure investors to understand the cost associated with their investment. So fees transparency is very much essential in mutual fund to ensure investor to understand the cost associated with their investment. And there are different types of fees in mutual funds. Especially I already explained 5 different types of funds: management fee, administrative cost, distribution cost, service cost, or audit or legal costs, and other expenses. When it's come, what is the importance of fee transparency here? You can see the slide here. Mutual funds required disclose the fees in fund prospects, especially in the fund prospect itself. It should be explained very clearly. Now there is one expense ratio. Already I have informed about expense ratio, how it is used. There is a table that how much expenses ratio has to be classified. Then the sales load, shareholder fee section, other costs like redemption fee, account fee, which has to be outlined with explicitity. So all these are very clear, systematically transparent. So there are different importance of fees transparency. One is about informed decision making. Investor can actively can make informed decision about the investments when they understand the fees involvement. Then comparability, fees transparency enable investor to compare the cost of different mutual fund. Accountability, like fund managers held accountable for their fees and performance. So there are multiple fees transparency based on different classifications. So informed decision making, comparability, and accountability. Then you have a regulatory requirement for fees transparency, like SEBI regulations, disclosure requirements. Now SEBI regulation, like SEBI requires mutual fund to disclose their fees and expenses in a transparent manner. Then there are disclosure requirement under fees transparency. Mutual fund must disclose their fees and expenses in the following document: scheme information document, key information memorandum, or annual report. So that's why I said that transparency of the fees is very much required. It is a required in form regular basis. So best practices of fees transparency, I can tell you, clear and the concise disclosure. Mutual fund should provide clear disclosure of fees, expenses. Standardized disclosure, disclosure format can facilitate comparability across different mutual fund. Then regular update, like mutual funds should regularly update their fees disclosure, reflect any changes if is required. Then fees of transparency in form of different benefits. So there is a increased trust. Fee transparency can improve, increase investor trust in mutual funds. Then improve decision making based on the investment plan. Better value for investor. Transferring can lead to better value of investor by promoting the competition among the mutual fund. This is all about the fees transparency. Coming to evaluating fees. So evaluating fees in mutual fund is very crucial to know the best value of your investment. So there are different types of fees evaluation. Again, fees evaluation based on the management fee, administrative cost, distribution fees, or audit fees, or any other expenses. And there are multiple steps to evaluate such kind of fees. Uh, you have a slides here. Compare about expense ratio, consider load, no load funds, examine turnover rates. Like if I talk about comparing expense ratio, they are written like look for funds competitive fees in same category. So when I talks about considering or comparing, when I compare fees across fund like research and compare the fees different mutual funds with the similar investment objective and strategies, then they go for checking the expense ratio also. When we go for evaluation, checking of expense ratio, look for representation of percentage of fund assets deducted annually to cover the fees and expenses. Then you can consider the fund investment strategy also, like passively managed index funds. Then you can go for fund performance, like you can consider fund historical performance and risk profile to determine which fees has been adjusted. Then we can check about different additional fees, like funds may charge additional fees such as sales load or redemption fees. Then assess with the impact of fees on return. It can calculate the impact fees on your investment return using outline or online tools based on the consulting with the finance advisor. Then key fee matrix to evaluate. That's why examining turnover rates. They talks about high turnover can lead to hidden transaction cost. This is how it goes. Many times we never know that what is the hidden cost. So there are expense ratio, management expense ratio, total expense ratio. Like expense ratio, fund asset deducted annual cover fees or expenses. We never know that how much expenses or fees have been charged in every fund. Then you have a management expense ratio, talks about coverage or cover management fees and expenses. Then you have a total expense also, asset value, cover all expense and fees. Then there are certain tools or resources under evaluating fees, like mutual fund company website to check the website fees information, which can be disclosed with the document. Financial planning websites, online tool, or value research, comparing fees, evaluating fund performance. Then you have fund evaluation through financial advisor. So one of the agency who can think about evaluation is an fund advisor. So consulting with the financial advisor to get personalized advice to evaluate the fees and selecting mutual fund. There are so many people who just go for evaluating the mutual fund performance based on what? Based on the evaluation about the financial advisor. So financial advisor will give a clear instruction about whether to invest or not. Then you have a key metrics. When we talks about key metrics to evaluate mutual fund, it shows the performance metrics like returns or returns based on historical return over a period of time, like 1 year or 3 year or 5 year. Here it is calculated expense ratio, a direct measure of fund ongoing cost, total cost of ownership, include all fees, load, indirect cost, providing a complete picture of expenses. Now this is how it will help to anyone to calculate in different manner, different process. Then when we go for classification, based on which classification here, understanding and evaluating the mutual fund fees is critical for selecting the cost effective funds that align with your investment goal. Lower fees typically correlate different type better long term return, especially passively managed funds, and always they review the fund prospects to assess its fee structure. Now coming to the key metrics here, there are risk metrics like standard deviation or Sharpe ratio. Then when you talk about standard deviation, it talks about fund volatility, or Sharpe ratio talks about risk adjusted return. Then you have a cost metrics like again expense ratio, total expense ratio. Then you might be having a portfolio metrics like asset allocation or top holding or turnover ratio, fund trading activity, which is called. Then there are certain other metrics too. So asset under management, evaluate fund size or scale, So fund manager tenure assess the fund manager experience and stability. Morningstar rating, what we call like provide summary rating based on the fund performance, risk and cost, which is called a Morningstar rating. So it is a summary of rating based on the fund performance, like risk and cost. By this way, you go for evaluating of your key metrics. Then the next slide talks about different types of investment risk. There are different types of investment, and it is very critical too. In that, first is an inflation risk. Now you should know that what is an inflation. Inflation risk refers to potential loss of purchasing power due to raising inflation, which can uh, evaluate the value of the investment. So risk attached with the potential loss through purchasing power. So how does inflation affect mutual fund? Like reduce purchasing power. When inflation goes up, reduce informed purchasing power of a people, lower interest rate, or increase expenses. This is the key factors here when we talks about the inflation rate. It is classified in what form. Here it is very clear, like when we go for calculating of inflation effect in the mutual fund, one people will not buy so easily because reduced purchasing power when inflations are there. Number two, lower interest rates. And number three, increase expenses. So inflation will decrease the purchasing power of mutual fund return, reducing investor real return. Then a lower return in form of negativity, impact on bond prices and the return. Then increase expenses in base of inflation can increase the mutual fund expenses, such like management, administrative, and in other expenses. Then there are different types of mutual fund most affected by inflation, like a fixed income fund or money market fund or equity funds, because it has a huge impact in the market. So when we talks about the fixed income fund, like bond prices return can be negatively impacted, or money market funds, commercial paper, treasury bill may not keep pace with inflation, or equity funds like equity can provide hedge against inflation, or consumer staple be more vulnerable to inflation. Then there are different strategy to mitigate this kind of inflation risk, but mitigation only thing is that you can diversify your investment, or you can diversify in form of commodity market. You should be very active while choosing the mutual fund experience through manager. So this is how it can be classified. So inflation matrix talks about different evaluation based on the expense ratio, real return. And you can see this slide. Investing 10,000 on the goods in today's market price. And another side you can say second column, if inflation assumed 8% per annum, which is fixed. Now same 10,000 after 5 years, it become 14,693 as an inflation rate, as an 8% of inflation. Then after 10 years it might be 21,000, after 20 years it might go for 46,000, and after 30 years it might go more than 1 lakh. So inflation same, by keeping 8% only year by year, inflation rate might go high. So you need to see that how much a risk return profile has to be calculated. And number two, you have a second risk is a liquidity risk, which is called fixed asset. It's called less risk than equity. Fixed asset are always less risk than the equity. Now here, uh, liquidity risk, you should know that it refers to potential difficulty in selling and redeem mutual funds or mutual fund shares quickly or with the fair price. Liquid, one of the liquid price, you will not get a actual fair price. When you want to sell, you can't sell it, or you can't redeem mutual fund share very quickly when it's come for liquid risk. Then here the causes of liquid risk or liquidity risk will be a liquid security or market volatility or redemption pressure or regulatory charges. When we call of market volatility, during period of high market volatility, mutual fund face a difficulty in selling of securities because they have a different prices. There will be no fair prices. Redemption pressures will be there. Large scale redemption can force mutual fund to sell securities quickly, and the potential distress prices, and the regulatory charges in the regulatory or tax laws can impact mutual fund liquidity. Then you have a different classification of a debt fund or sector fund, and you go for this mitigating this liquid. The mitigation of liquid risk can be done by either by diversification of fund or liquidity management, stress testing, or disclosure. And evaluation of this liquidity will be liquid ratio or cash or equivalent holdings, turnover ratio, redemption pressure. This is what called about liquid risk. And the next you have a credit risk. Normally everyone knows that when borrower to pay principal as well as interest as an agreed schedule, that become a credit risk. Now credit risk, potential loss of principal or interest payment due to issues, inability or unwillingness. See, one of the credit risk is the person who have been borrowed money is inability or unwillingness to meet their debt obligation. That become a credit risk. Somebody has taken money but later case not able to make payment, so that become a credit risk. Now how does this credit risk is classified here? Default, one of the example, credit risk is default or downgrade risk or liquid risk. When I talk about default, interest on principal payment resulting in loss of the mutual fund, or downgrade talks about reducing the value of mutual fund holdings, or when I talk about liquidity risk, will be holding quickly enough and at fair price, but they go for extrapolating about the losses. Then if you see the mutual fund, most affected credit risk are bond, credit fund, hybrid funds. Then I can go for how to mitigate. Again, mitigation remains same, like you diversify fund, and you should know the credit analysis. You should have a risk management team with you, regular portfolio rebalancing. Then you can evaluate credit rating, profitability, or duration of income. And you have a one of the credit risk can be mitigated by regulator recommend, like SEBI and the risk management framework. Like SEBI provides guidelines to mutual fund to manage credit risk, or risk management framework like identify, assess, and mitigate credit risk. This is how credit risk has been explained. Then you have a market risk and the price risk. So if you see the market risk, it refers to potential loss of value due to change in the market condition. Market has been changed, it has an impact on the market and it will lose the market. And one of the market risk talks about interest rate risk or equity market risk, currency risk, or commodity risk. When we talks about interest rate, change in the interest rate can impact on the bond price or the return, or equity market, fluctuation in the stock price have an impact, or if you talk about currency risk, exchange rates has an impact. If you talk about commodity, impact on the commodity linked investment. So there are different types of risk enabling to cover with the or mitigate the market risk. Then you have a price risk. So price refers to potential loss of value due to change in the price of individual security in the mutual fund. So individual changes automatically has a impact in the market, and how it is connected and why it is connected, in what way this is considered. So all these are classified based on what potentiality or ability of risk management. This is how it works. So uh, price risk refers to the potential loss of valuable due to different changes. Then factors affecting market risk price will be economic indicator, geopolitical events, company specific event. Then you have a different strategy to mitigate the market price risk, like you can diversify asset allocation, hedging, regular portfolio rebalancing. And key metrics to evaluate the market price: beta, standard deviation, and Sharpe ratio. All these are classified under market and different security market risk. So here we are seeing so many types of risk here. Then when it's come for different type of interest rate risk, we should know about the various types of interest risk based on what. So how does the interest risk work? Like when interest rates rise, the value of existing bonds with the lower interest rate falls. Investor can earn higher yields, newly issued bond. Then interest rates fall, value of existing bond with higher rates rises. So interest rate changes sometime, bond duration, credit quality, or market liquidity, and there are different forms. So there are different strategies to mitigate interest, like again the same diversification, then duration of management, interest rate hedging, and many other. So finally, we have seen different types of risk and how it can be evaluated. So interest risk, investment value change, as well as rate of interest will change. So there are risk measurement and management strategy like to avoid, diversify, and take position to benefit from some event or development. This is what is explained here. So thank you for listening. Remaining classification we'll see in the next class. So I've been covered with all type of risk which is required by every mutual fund to mitigate. Thank you all.